All right, good afternoon, everyone. Sorry about the little delay, just some technical issues on this side. Let's just do a quick audio and slide check here. If you can hear my voice, you probably see a couple of lovely faces there on the screen. Um just type a Y in the question box there. Just let me know that you can see and hear okay. All right, looks good. All right, so there's a request. People want to see my beautiful face too, I guess. All right, welcome everyone to this presentation hosted by FFR Trading and Trader's Edge. My name is John Madison. I'm the senior strategist here at FFR Trading. I'll be your host for this special educational webinar, Maximize Your Profits, the benefits of trading option spreads in today's market climate with Joe Duffy. Joe will come on in just a moment. Feel free to post questions during the webinar, but we'll have a kind of formal Q&A session after Joe's done with his presentation. Just a reminder, everybody that stays till the end will receive a complimentary 90-day subscription to Joe's Key Point Options Trade Service videos. All right, this is a daily video newsletter with weekend updates, daily analysis, current opportunities in the market, and daily trade recommendations. So you don't want to, you want to stick around. Make sure you get that amazing bonus from Joe. At the end of the webinar, we'll also bring you a rare opportunity to elevate your financial game. For those looking to make a tangible difference in their financial future, Joe is offering some of his invaluable services to retail traders. As a follow-up to the webinar, you will receive either an email or a phone call from us, get your feedback. Tell us what you liked, what you didn't like. Feel free to offer suggestions as how to improve these sessions. Again, these sessions are for you guys. All right, some questions to ask yourself before we get into the content here. Are you content with your current financial state, or is something missing? Perhaps you're already successful in trading, but ask yourself, are you reaching your full potential here? Could an experienced trader with a track record navigating the market successfully over 25 years help you achieve your financial goals even faster? If you're not having success, which the majority of people out there trying to trade are not, what steps are you willing to take to get back on track, and reach your desired financial future? Today's webinar is going to be an opportunity to explore solutions, that can guide you towards a more impactful financial journey. So make the most of your time here, invest in yourself, and look forward to a secure and a better financial future. All right, you should see the risk disclosure up here. Again, you guys are aware, right? Trading is risky business, right? And that's why FFR exists, because most people fail trying to do this, right? That's why we pair you up with proven traders like Joe, with proven track records, and diversify you among these strategies to help mitigate that risk. All right, so what we want to cover with you today, obviously we'll review FFR here, who we are, what we do. I'll introduce you to Joe. When he's done with his presentation, we'll have a Q&A session with Joe, and then review the trade academics of his programs and the educational material and everything that comes with his strategies. All right, who we are at FFR Trading and what is our role here? We're a boutique vetting firm. All right, that means that we've been evaluating traders and their strategies for over 15 years. Right, we're looking for veteran traders with proven track records. So we sift through the thousands of strategies out there to bring you the best of the best. We do that through our 8-step certification process. So each trader has to go through this process. They're thoroughly vetted, just like Joe has been, before they're able to provide their services to our clients here at FFR Trading. All right, so a couple of the programs that we're going to look at today. Joe's Target Zone Option Program, that's a spread trading program, and his Key Point Trader. Joe, if you would, first of all, let me just kind of introduce Joe here. Uh, Joe, I think the last time we spoke, you were on vacation. It looks like you're on vacation again, no? Wh-
Um, Working vacation, John.
Okay.
Working vacation.
And where would you be joining us from today?
Palm Springs.
All right, beautiful. Guys, if you don't know Joe, basically Joe launched his career by becoming a three-time top 10 finisher in the United States Trading Championships with triple-digit returns, if I remember correctly. The USTA, it's a real money trading competition. I think you parlayed that into a proprietary trader gig with one of the top banks in the world. I know you were voted the top analyst by the Greenwich Survey. I think that kind of sums up some of the highlights of your past career, Joe. But what are you doing now? What keeps you busy?
I trade futures in the hours before the New York Open when it's calm. And I do share that my trading screen on Skype. Anyone who wants to get up early with me pre-market, so you can watch me trade, watch the trades, copy them if you want, use it as a confirming indicator if you want, do whatever you like. I don't trade futures during the day because it's too crazy. Too many bots now run everything, and you just get run over way too quick. But trading in Europe is an awesome place to do it. So that's one thing I do. And during the day, I'm doing, I do option spreads. And the great thing about spreads is, you have a view, you put the spread on, and then you can kind of, you don't have to, you're not glued to it like you are, say, with a futures trade. So yeah, I'm a couple hours in the morning trading futures and then looking at the market. Some days more than others, but just keeping an eye on what's going on, and that's pretty much sums it up.
All right, and tell us a little bit about the two programs here, maybe the differences between these two programs and why they're kind of complementary with each other.
Okay, key point options is probably just what most people are familiar with, which is buying puts and calls. A directional bet on the market, unhedged. That program will get active and then dormant. And like right now, it's pretty dormant because the premiums on options are so exorbitant that it's a large hole to dig out of buying an option and then trying to furiously dig out before as the time value erodes exponentially. Now, keep our target zone uses spreads. So one of the objectives of the program is to take advantage of the exact thing that Key Point tries to avoid, which is trying to get those time values, huge time values in short-term options to work for me instead of against me. So they're complementary. Target zone's a little bit, well, not a little bit. It usually takes a longer-term view. Option spreads are at least a month out, and sometimes one leg can be several months out. Key Point Trader, even if I buy something that's 4 to 6 weeks out, I really like to have it off in 2 or 3 or 4 days, just because of that erosion of time value. I don't want to get into it, so it's a much more short-term oriented than target zone is, and it's more aggressive. When you're buying puts and calls, it's more aggressive than target zone. Your risk is higher, and it's just more aggressive.
All right, yeah, appreciate thorough explanation between the differences of these programs here. So what I'll do, Joe, is I will get ready to turn things over to you and get your presentation rolling here. And when we come back, guys, let me see if I can get this working here. We'll have a Q&A session with Joe. So if you have questions, you can post them, and we'll get Joe to answer those questions. And then we'll go over the performance of his services, so you can see how they've done over the years, and then everything that comes with these services, and then we'll make you a little offer at the end. All right, Joe, it's over to you.
Okay, so what we're going to talk about today is spreads, for those who aren't familiar with spreads and how they work and how they can be used to your advantage. Now, if you have a familiarity with what a covered right is with a stock, and just very briefly to summarize for those of you who are really new, you buy a stock at $50, and then similar to like a real estate option, you can sell an option to buy that stock from you for say $52, and you'll receive $2 for that option. So if you buy the stock at 50 and the stock goes to 55 and somebody, exercises your option, you get, the $52 that they paying you plus the $2 you got for the option. So you own something and then you write an option to buy it off you against. Now, conversely, if that stock was $50 you bought it for and it went to 51, that $2 call that you just written against the stock is now yours. So you've now made $2 on your stock, bringing your cost down to 48. So that's the concept of how options work if you're writing them. Okay, and that's what the floor brokers do, is they write options to us guys who are buying them and digging ourselves a hole trying to climb out. So what we're trying to do is take advantage of that declining time value in options. Now I've got my real trading screen up here, and I'm going to hopefully, looks like these prices are still up. Sometimes Interactive Brokers takes them down about right now, so hopefully they're going to stay with me. So let's just say that, for example, I'm going to pick Amazon. Amazon's a little bit over $98. So a call, if I'm bullish on Amazon, a call to buy Amazon for $98 in the next 22 calendar days, so about 17 or so maybe trading days. You can see if you follow my cursor here, that call is worth $4.20. That gives us the option to buy Amazon for $98, right? Now, again, Amazon stock is trading at a little over $98. So it really has almost no value. That whole $4 that you're paying is time value, all right? And that time value is going to decrease at an exponential rate. So as we get to March the 3rd, that $98 option, which has a $4 time premium, will have a 0 time premium. So if the stock's worth 98, the option will be worth 0. If the stock's worth 100, the option will be worth 2, et cetera, et cetera. Okay? So you can see that if we're bullish on Amazon and we buy this stock, or we buy this option, what we're essentially doing is saying, okay, we're digging ourselves a $4 hole. The stock's 98, but we're going to pay $4 for the option. So we're going to dig ourselves a $4 hole, and then we're going to hope that we can time it well enough that the stock moves fast enough that we can dig it out of that hole before expiry. Okay, and we can sometimes, but as you can see, you really need good timing and good patience and good selection in your stocks if you're going to continue to use that strategy where you're putting yourself a little bit at a disadvantage right off the bat and then trying to climb out. Okay, so it's still okay in certain circumstances, but as a general rule, it's a hard thing to do. So what can we do with spreads that can mitigate some of the downsides of outright puts and calls? Let's say we take this same $98 option, right? And we're going to buy it. And we're going to, just like a covered right, remember the covered right example? We now own essentially 100 shares of the stock per contract, right? That's what an option represents. So essentially we own the stock. We can now write against it. So let's say that we buy the 98 and then we sell, let's say the 104. Okay, so you can see here's our difference here. It's about $2.35, right? So if we buy the 98 call and sell the 104 call, we have to pay about $2.35, halfway between the bid and ask. Now, instead of having the stock to go up $4 for us to break even, now we only have to have it go up about $2.40 or so. All right. So we've eventually cut our risk in half by doing that way. Now, is there any downside to this? Well, I wouldn't say it's a huge downside, but if the stock goes through 104, we're not going to make any more money than the difference between 98 and 104, which is $6. So this option that we're going to pay $2.40 for, if the stock goes through 104, it's going to go to $6. That's much greater than a double. You know, very, very rarely do people hold on to options where you're going to make more than a double on the contract, unless it's a lotto, a very cheap option that the stock moves in a hurry right near expiry. So we're not really giving that much up in order to lessen our risk on this trade. Now, if the stock goes down and we're wrong, because sometimes we are, what's going to happen is the amount of money that we're losing is also going to be mitigated, because yes, we're losing money on our long 98 call, but we're also making money on our short 104 call. So this spread will not drop nearly as fast as if we just had the 98 call alone. Okay, so we do give up a little bit of upside, and I think it's almost theoretical upside, but we gain downside protection and we can take less risk. So that's one way we could use this. Now, there's other ways we can do it too. There's lots of ways we can set spreads up. If we're bullish on Amazon, what we could also do is sell a put. Now, this is a concept that it's not difficult, but I know if you've never heard it before, it can be tricky. So I'm going to go through with Amazon, and then we're going to go through with something else next. So if you're not 100% following in this example, don't worry, because we're going to do it all again. All right, so let's take a 100 put. The stock's 98, so we're going to sell 100 put. Right now, this stock, if we sell 100 put, we're going to need something to protect it. So we're going to buy let's say a 94 put. Okay, so in this case, we're getting more money. We're paying the 94, which is $2 and 21 cents, and we're getting paid $4.70. So this time we actually get a credit. Okay, so we get a credit of about $2.65 here. All right. Now, what's our worst case scenario? Well, our worst case scenario is we're completely wrong and the stock goes down through 94 instead of going up. In that case, the exact same thing as the last example. Our worst case loss is the difference between these two strikes here. So our worst case loss was 100 minus 94 is $6. So that's the worst that's going to happen, is we have to buy this strategy back for $6. So we get a $2.65 credit. We have to buy it back for $6 if we're 100% wrong, and so we lose $3.35. Now, this particular isn't a spread that I would do because I don't like to risk more than I can make. However, have a look at this aspect of the spread. We're getting $2.60, which means our break even is going to be about $97.40, which, and how I got that is $2.60 minus 100 is our break even point. So as long as the stock is above $97.40, this is going to be a money making strategy. Now, what's interesting is I had here, it's already above $98.25. So if our break even is $97.40 and it's already $98.25, if this market stays dead flat and we hold it to expiry, if we did, we would make money on this option. So just get your head around that, because when we were looking at buying the straight put or call, we were paying $4.20 and then getting ourselves in a $4.20 hole, and then hoping we can dig out of it before expiry. So in this case, we're doing the exact opposite. Now, instead of digging ourselves a hole, we're letting someone else see if they can dig out of the hole. So all we need is for this market to go sideways, and if it goes up, great. We're going to profit this whole credit received that we got. So anything above 100, which is only a $1.75 rally, we're going to make the entire credit that we sold the spread for. Okay, so in this case, $2.60 or whatever. Now, let me just change a couple of numbers here, so and see if we can get a better looking spread. Let's go 98 and 104 and see what this does. I'm working this through with you like I would during the day, all right, and looking at stuff. Okay, now this one's now. So we get $3.60 for this spread credit. Okay, it's a credit spread. So our break even now is going to be about $3.60 minus 104. So our break even now is $140. Okay, so now the market has to rally a little bit in order for us to make money. But still, we can only lose $6. Okay, but we're getting $3.80 or $3.60. So now we're risking $2.40 to make $3.60. A much more favorable risk-reward ratio. And yes, the stock does have to move $2 in our favor for us to make money, but that's still only half as much as it had to move if we had bought the straight put or call. And here we stand to make 360 while only risking 240 at a worst case. Okay, and so you can see how we flip the equation around now. Instead of digging ourselves a hole, we've let someone else dig the hole. Okay, now I'm going to go through one more example with Amazon here. If you've ever been on, or you've heard me talk before, you'll hear me say, well, things are on sale, things are not on sale. This option spread looks good. Oh, I really like this stock to go up, but I couldn't find a spread that I like. And the reason is because it's just like anything else in life. The market prices things differently due to a myriad of factors, some of which I don't even understand. But right now, the market is making it easy for you to be bearish, okay? And I'll show you how. Let's say that we think now that Amazon's actually gonna go down, okay? So we're gonna sell a 98 call. Let me get rid of this. We're gonna sell a 98 call for 420, and we're gonna need some protection on that. So we'll buy the we'll buy the 103 call, so 5 apart, okay? Now, we're going to receive about $2.10 or so we're gonna get as our credit, okay? Now, in this case, as long as the stock ends up below 98, we pocket the whole $2.10. Well, the stock's basically at 98 now, so if it goes sideways, we're gonna make the whole thing. Okay, it doesn't even have to move in our favor. Of course, if it moves below 98, we're golden. We're going to make the whole thing no matter how far it moves. Our risk, again, between 98 and 103 is $5. So if we get $2.10, we're risking $2.90. Again, I wouldn't do this spread because I don't want to make 210 and risk 290, but it just goes to show you that we've completely taken the time value out of the equation. And while risk reward is important in deciding what options we're going to take, so is probability. And basically here, when you're repaying absolutely no time value for this option, any time between now and March 3rd, when this expires, anytime the stock goes below where it is now, this option spread is going to be profitable. Okay, so there's no time value to fight. If it happens next week or the week after, it doesn't matter. As long as the stock goes below where it is right now, at any time between now and March 3rd, this spread will be profitable. So take that thought, and if you've traded options before, you know that the stock can be in your favor and your option's still not making any money because it's losing time value. But we've taken time value out of the equation by using the spread. Now, I'm going to go one more here and change things a little bit even further for you, okay? So you can see how these things can interact. I'm going to sell the 90 94, and I'm going to do it against the 99. Okay. All right. Now this time we're basically going to get $3, say. All right. Again, what's our risk? $5. All right. The difference between 94 and 99. So we're going to get 3. So we stand to make $3, and the most we can lose is 2. Because if we have to buy it back for $5, we got 3, we pay 5, we lose $2. So now risk rewards in our favor. However, we now need to get the stock below $3 minus 99. It needs to be below 96. Okay, so it has to move down a couple of dollars in order for us to make money on the spread, and it needs to go below $94 for us to make the whole thing. Okay, so in this instance, what we did is we traded a little bit of probability. Now the market has to go our way at least a couple of dollars, but we tilted the risk reward. You know, remember before we were risking $2.90 to make $2.10. Well, now we're risking $2 to make $3. Okay, so we tilted the risk reward, but like a teeter-totter, now the stock has to move our way a little bit, right? So our probability is tilted a little bit. And these things can change, and I've seen where lots of times where it's actually a discount where they pay you just to sit there. And it will shift all the time, and part of trading option spreads is just checking out the legs and the spreads and how they go, because sometimes things are on sale, and when things are on sale, it's a really great time to do them. And what happens, we can be bullish on the SPY. We'll move to the SPY here in a second, but I just want to give a brief detour. We can be bearish or bullish on the SPY, and the SPY options may not be such a great deal. You know, like you might have to risk 3 to make 2, and I just said I don't really like that. But you might go to a stock that you don't like either, and instead of having to risk 3 to make 2, in that stock you might only have to risk 230 to make 270. Okay, and it's the same directional play you would have taken on the SPY, except now you're doing it on an individual stock. So things like that are really important in option spreads, because the prices, something's on sale somewhere. It may not be the thing you want to do, but most of the time something's on sale somewhere. And it's weird how it always changes, but it does. So yeah, the SPY would be a good example to show you what I'm talking about, because right now it's really slanted in one direction. Am I going to get these calls up here? I am. Okay, let's say that we're bullish on the SPY, right? The SPY is 407 and change. If we buy the 407, the 407 is $9.58. Ouch. That stock has to move almost $10 by March the 3rd just for us to break even. That's a big move. 10 points is a lot. That's a big hole to dig. So 9.5 points, almost 10 points when you consider you want to make something and pay your broker, you know, almost 10 points just to break even. That's a lot. So how can we mitigate risk? Well, again, we could go up and sell, we could sell the 412s, okay? Now, our cost has now gone from $9.50 down to about $2.75. Crazy, right? Now, if that stock goes through 412, this $2.70 option is going to go to 5, right? So at 412, if we had bought the straight call, we'd have still lost half our money. At this case, if it goes through 412, we're going to make $2.30. So a loss of 50% versus a gain of about 80% just by setting up the spread. Now,
Joe,
let's change this around. Let me get rid of these two. Let's just say that we were bearish on the S&P.
Joe, can you hear me?
I can hear you.
Oh, okay. Hey, I just wanted, somebody popped in a question, and before you get too far, I just want to see if you can maybe answer this one, because it was kind of pertinent to what you were covering there. This is from David. He just wants to know, could you chase the profit down? I think this is on the prior example you were talking about. Could you chase the profit down by buying back the 103 and selling the upper and lower at a lower strike to improve the risk reward ratio when the stock price goes down?
Well, you can always do that, okay? But you have to remember that risk reward and probability are like a teeter-totter, okay? So if the market starts going your way and you change the spread into a more aggressive spread, yeah, it certainly gives you more upside, okay? So it increases your risk reward. It increases your reward at least, but it also increases your risk, okay? Because now you don't have as much protection if you extend that higher strikeout. You won't have as much downside protection in case you're wrong, right? So yeah, you can do any of that. I usually don't do it. I don't usually do it. In fact, I almost never do it that way. I will rearrange my spreads, but I would rarely, if the spread's going my way, I rarely lift the leg to make it more aggressive. Because I put it on knowing that I was trying to mitigate risk. And once it's on, I don't usually increase it. It's almost never. I can arrange them other ways. I don't want to go too far into this, but if you were, for instance, long the call at 407 in the SPY and short the 412, and you went, oh geez, I thought it was going up, and now I think it's going down. Okay, you can buy the 412 back and sell the 402 or 403 or 398 or whatever you would like. So you can change that spread around from what was a bearish bullish spread into bearish spread. I will do that. But I don't usually chase. If it's going my way, I don't usually chase it or make it more aggressive. I don't usually. Or very rarely even, almost never.
Perfect. Sorry to interrupt you, Joe, but it was a good question. It was perfect.
Yeah, no, it's a great question, actually. Yeah. Because just remember, it's the teeter-totter, right? And I know the whole world talks about risk reward. Obviously it's important. Who is to say it's not important? But I hear all the time, oh, you got to risk two to make. It's got to be 2 to 1, or it's got to be 3 to 1. Well, I can tell you that it's much easier to trade at 65 or 70% accuracy, risking 1 to make 1, than it is to trade at 50% accuracy, risking 1 to make 3. 3 to 1 risk reward very rarely happens, and I don't think people pay attention enough to the probability of the trade because they're so focused on risk reward, like their computer, the market doesn't care about your computer model. Part of this option strategy is what's the probability? If the stock goes sideways, how am I going to make out? I'm going to show you a strategy right now where the probability is very highly in your favor if you're bearish, right? So let's look at the SPY here. We're bearish on the SPY, say, and this is a hypothetical example. I'm not saying I'm one way or the other. We're going to sell the 407 for $9.50 or whatever, and let's take the we'll buy the 417. We'll go way up here to the 417s. So we're going to get $5. Okay, you can see here the spread, the middle of that spread's about $5. It's after hours, so these are closing. During the day, these numbers are even tighter. But we're going to get $5 for this spread. We're going to buy the 417. We're going to buy sell the 407. Okay, just like a covered rate. You own something, you sell something against it. Now, the stock is barely above 407 now. Okay, so if this stock, SPY, ETF, stays right where it is, okay, if you see my cursor here, it's 407 and 58. If it stays right where it is for the next 3 weeks, this $5 credit that we received, we're going to have to buy that back for 58 cents. Okay, so we're risking about $5 to make $5, but the stock has to move $5 against us before we would even lose any money. If it goes $3 against us, we're still going to make money. If it goes $4 against us, we're going to make money. It has to go greater than 5. And I'm only risking $1 or $5 to lose $5, but I've got a $5 cushion. Okay, so you can see what's on sale here. Now, if I was bearish on the S&P right this minute, I would look at this and say, man, that's a monster sale. You know, it's Marshalls, it's, you know, Target, whatever, right? It's a monster sale. I've got a 1-to-1 risk reward ratio with a large probability. If we consider the probabilities at 50-50 that the stock's going to be higher or lower, I've got a $5 cushion on a 1-to-1 bet, and the probabilities are whatever they are, you know, certainly higher than 50-50. So, and these things shift. It could 3 months from now, it could be a bull spread that looks like this. So, what's on sale in the market is a big factor in doing spreads. You want to get the direction right, of course, but looking around what individual stocks are setting up in these kind of favorable opportunities is a big part of it. Okay, any more questions, John?
Let's see, nothing at the moment, Joe, if you want to
continue. Okay, guys, just to reiterate the important parts then. As opposed to buying a put or a call, remember, if we wanted to buy that SPY options, the SPY right here with my cursor is 407 and change. If we wanted to buy that SPY call, it's almost $10, $9.50. So you're digging yourself a $9.50 option hole just and hoping to climb out in time. That's a big hole. Once you set up a spread, you substantially mitigate your amount of money you have to put into it, the amount of money it has to move in your favor for you to make money, and you're also mitigating your downside, because if it goes against you, you're going to be losing less money on the spread than certainly you will be on an outright put or call. So that time value of options is the worst thing that's the floor trader, sorry, the retail trader is fighting against. So what we do, and this is how floor traders make money, guys. The person who's selling you that $9 option is the floor trader. He picks it out of thin air. He essentially, manufactures it. So he just sells you that option, and then what he does is he'll buy enough stock in the market to cover. If the stock does go up, and if it goes up a bit more, he'll buy a bit more. But he's going to make that $9 time value no matter what. Stock goes up, stock goes down, he's still going to make his time value, right? And we're the ones, the retail guys, that are paying it away. And that's why 80% of options expire at zero, because of time value. So what we want to do in spreads is let's get that time value working for us. And sometimes in the last SPY option I just gave you, you can get it working for you in a huge way, right? If the direction that you want to play is what's on sale, big opportunity. Okay, no questions is a good thing or a bad thing? Have I explained it really clearly, or is everybody stuck in the mud?
Yeah, no, Joe, let me get to the questions. So guys, go ahead and post your questions for Joe, and I will relay them to him. All right, let's see. All right, Victor asks, so how do you decide what direction for the market?
Well, that's other stuff, right? That's a seminar or more than another day. I mean, I do have some stuff that's provide a couple of things, but basically the same things that I trade, I guess would be the short answer, when I'm trading the futures and using 2-minute charts, are exactly the same things I use, on daily and weekly charts to look at the options. So I have something called Scoop that I use, which basically helps me buy dips in a trend or rallies in a downtrend. I don't like to buy breakouts, but I do like to see an established trend and then try to get in at a retracement. So that's usually my strategy. And I have some things that help me do that. And but it would be beyond what I can obviously tell you, in a verbal answer right now.
And obviously, Joe, these are things that you cover in your service. They'll have access to.
Yeah, I mean, I do. I put it up on the screen in the videos, and even though I think there's only been very few people actually show up early morning to watch the futures trading, but if you're there, you can watch me do it. It's not. It's not. I'm not trying to keep it, a hidden secret, but it's much easier to trade in Europe. So yeah, I mean, I'm in that respect. If you want to learn and you're willing to get up early, yep, that opportunity is certainly there for you.
All right, and DJ asks, how do you pick there's several questions about how you pick your strikes. Do you use the delta? Are you typically looking for one-to-one risk reward?
Well, again, I think the Greeks are important, and I'll tell you what, this is a whole nother side story, but I've talked about it before, but the options market has dramatically, and I can't even overemphasize how dramatically it has changed the whole landscape in the last 3 years, say 2-3 years. What's happened is there's so much notional value in options. And I'm sorry, I'm going to answer your question, but I just wanted to get off on this little tangent because it's important. So much notional value in options that if people are buying calls, and I mean, now there's, I think, 1.7 times the dollar value, the notional dollar value traded in options as there is in stocks. So options are no longer the derivative. The tail is now wagging the dog, because what happens is all these options get bought. If they're call options, what happens, the floor trader has to hedge the call options he's selling to you by going in and buying physical stock. When they start to go in and buy physical stock, what happens? Demand is up, price is up. So it becomes a vicious circle where the options are actually driving the market. And even in the last year, even less than a year, where gamma is on the day of expiry options is driving the market day to day. And it's so, I can't even tell you what a different experience it is than 3 years ago. Now, delta is basically just how much the option is going to move for $1 per dollar move in the stock. Now, if you're a floor trader, you need to know what the delta of your options are, because when you sell an option, you have to know what the delta is so you can buy that ratio of stocks to cover your position. But I don't look at the Greeks or anything like that. Gamma is important for the reasons I just said. Knowing where the pain points are, and who are they going to try to the pain point being, if it gets above or below this point, it's going to actually feed on itself and exacerbate the trend. All that's important, and it wasn't with us 3 years ago, at least not to the extent it is now. But I don't use the Greeks largely. I will just look through like I looked through with you guys today. I mean, none of this was prepared in the sense that I wasn't cherry picking any strikes or examples or anything else. I was doing exactly what I would look at if I was trying to decide I want to buy the S&P or sell Amazon or buy Meta stock or Meta Facebook or Apple or Nvidia or anything. I'm just going through the process, looking at different kinds of spreads. What makes the most sense? Anything on sale? What's the best deal? And I think that you don't need to know all the Greeks to know that. You can just look at it, and everybody knows that if I have to risk if I have to risk $3 to make $2 in the S&P, but I can buy Apple by risking $230 to make $270, then I'm going to buy Apple because it's a much better deal, right? So that's how I decide. I don't look at the Greeks. And if once I decided Apple, then I'd look at the different strategies within Apple to see which one I kind of liked the best. So it's really, anyone can do this if you have time. Honestly, there's no There's no advanced math. You don't need to know the Greeks. You don't. It's not 100% not necessary. In fact, I'd say it's unnecessary, but you absolutely don't need to do it. You just need to look at the various things, and it's comparison shopping. It's not brain surgery. Um, things are on sale sometimes, and things are expensive sometimes, and you've just got to look around and poke around and find what's the best value. And sometimes you're still wrong. If you got the direction right, it doesn't matter what the best value was. You may just lose less, but other than that, But it's still an important factor. Figuring out which options are your best value or spreads are your best value is a very important factor.
And this kind of follow up to that, Rick asks, how do you determine what is on sale?
Well, like I said, I think I probably just answered the question, but without knowing I was answering it. But if I'm bearish on the market and I look at the SPY and I see a spread there where I can make $2, but I risk $3, I'm not that fussy. But then if I look at, let's say, I don't like the looks of Chewy either, for just to take a name out of my head. And there I can risk $2.30 to make $2.70. Well, I'm going to way do Chewy and not do the S&P. So it's a trial and error. What stocks do I not like if I think the market's going down? Which stocks don't look good to me? And then go through those and see which ones look like they're the best value as a spread. What offers the best risk reward, and then balancing that with the probability of where the options are. Yeah, it's guys. It's not anything more. It's almost like getting your grocery flyer in your mailbox and looking to see where's milk on sale, like our parents used to do, right? It's really almost is that. It's not complicated Greeks or anything like that.
All right, perfect. And let's see. Al wants to know, do your subscribers get the scoop indicator?
I have. It was for sale for a while, and it's not for sale right now. But if anybody, it's available for Trade Navigator, for TradeStation, and I can probably do it for TradingView. So you don't get it, but you could email me and I'll see. That's the best I can say right now. I mean, I know it's out there, but it really is such a good thing for me, and I use it all the time that I thought, what? Why am I marketing this thing? Let's just hold on to it. So,
Joe, let me ask you: can we offer it to those that sign up for your service?
You know what? I need to think about that because I've already told people who've asked about it. Nah, I don't think so. So, you know what? They can email me and I'll see. But
just the people on this webinar, Joe. Just the people on this webinar, if they purchase.
Okay. All right. Okay.
All right, guys.
It's got to be Trade Navigator, TradeStation, and TradingView. I need a little lead time to get it written, but yeah.
All right. Perfect. Much appreciated.
But not, this isn't something that's going to be, I'm not marketing this anymore. People have, I know, like honest to God, I'm not lying. People have paid $10,000 for it. So, yeah, and it's worth it. That's why I stopped marketing. I'm like, what am I doing? This is what I use. Just leave it.
Well, that's awesome. So, guys, yeah, hope you do appreciate that and take advantage of that because, like you said, Joe has charged $10,000 for this indicator in the past. So let me do this, Joe. I'm going to take control back to you here. Let's see, and I will show my screen here. All right, and what I'd like to do guys, is get into the learn and earn aspect of the programs here. So let's talk about both the target zone and the key point options program. Target zone is that spread trading program Joe talked about. Some of the academics of the program, it trades the top 100 most liquid stocks and ETFs. Right, trades an average of 4 to 6 trades per month, depending on market conditions. Minimum account size Joe recommends is $10,000. He's allocating 10% per trade alert on the overall account size. Right, mainly trading debit, credit, diagonal spreads, sometimes straight puts and calls if the market calls for that. All right, here's what I want you to take a look at. You can see the, I'm going to turn my video on here so Joe's not alone. All right, here's the performance of target zone. This is going back, this is 6 years worth of data now, I think, based on a $10,000 account size, allocating $1,000 per trade. Again, from January of 2017 through January 9th of this year. You can see the total return on capital there of 1,053% during that period. All right, that's a net profit of over $105,000 on a $10,000 account size. These are non-compounded, folks. All right, these are not compounded, non-compounded numbers here. The monthly average, so on average, the monthly returns about $1,400 per month. All right, he's averaging an annual average return of 175% per year. All right, he's winning 75% of the trades. All right, here's the beauty. The average winner, even with the high win rate, right? The average winner is $672. The average loss just $449. Right, and if you see the equity curve here, this is what gets the equity curve moving in the right direction. All right, that high win rate plus the wins are larger on average than the losses. Joe, tell us, just since I still got you here, when you look at this equity curve, obviously it's moving in the right direction over time, but there are periods, right, when there's flat periods too, right?
Well, for sure. And I think I alluded to already, like the market, I can't even tell you how much the market's changed and the drivers of the market's changed in the last 3 years. I don't know where we're heading because it's changing all the time. But the flat periods, I'm okay with. It's almost like it's like a stock. You own a stock, it goes up, then it consolidates in a flag pattern or a sideways pattern for a while, and like in the old days, then it goes up again, right? So the sideways patterns are when you buy it, and that's basically kind of like what Scoop is. You wait for the sideways patterns, wait for the retracement, and then it signals you buy it. So, the fact that I'm in a bit of a sideways now, if you look at the market, well, it's been in a sideways for 4 or 5 months. So yeah, I'm not. The sideways is for me, it's the time to get in, not the time to say, oh, this isn't going to work anymore. I mean, it's like the last sideways pattern we had. It comes out the top. That's the way I look at it. It's like, I relate everything back to my own trading because I'm trading maybe 3 hours a day on my own with my futures account or whatever. But when you have a day where you don't make any money, it doesn't mean that you don't know what you're doing. You just execute your process, and you go to the next day, and eventually the market's going to come around to moving in your direction again instead of just chopping around. And if you look to the other thing, John, is we talked about how much time value is on those options. Like you wanted to buy a SPY call at 407 and it's $9.50 for 3 weeks. What? Come on. If you're trying to trade options by giving away that kind of premium, and you were sideways, you'd be the best trader on earth probably. So the sideways, honestly, is just part of the game. It's just, the game is just execute your process, and eventually things come your way. And the market's changed so dramatically over the last 3 years, and it's it's become more difficult for sure, but the rewards are still there. It's just a little bit different, and sometimes you have to sit through more sideways, and we're not in the same, it only goes up mode that we were, right? So through the chop, I'm happy to have been to survived it, I guess is what I would say.
All right, and we're going to talk about your key point option trading program. You talked a little bit about that earlier, but again, this is a little different than target zone. So
well, it will go. It traded fairly actively in the summer and fall last year because time premiums weren't. Well, the market was more directional. We were playing the downside. Had a lot of good trades, and then the market became more choppy. And the greatest thing about that, I really thought, people say, why aren't we doing any more trades in key point? Well, because right now I'm not paying away these huge premiums in a choppy market. And the greatest thing about key point is it didn't have to run into a bunch of losses to realize, oh, the market's too choppy to trade. We recognized the market was too choppy to trade, and then we stopped trading puts and calls. Okay, so we didn't stop trading puts and calls because we were getting chopped up. We stopped trading puts and calls because we could see we were going to get chopped up. Okay, so we were pretty active, and I think we were like 12 or 14 or something through the fall, through about a 3 or 4 month period in the fall, and then we just stopped it because, like I said in the SPY example, I am not going to pay $9.50 for an option that has 3 weeks to expiry in the SPY. That is insanity, and I will never voluntarily dig myself that big a hole just to find out if I'm good enough to climb out. So I just stopped doing it because there's nothing good to do. But it will go in cycles. There'll be times again, and sometimes there'll be stocks that have lower option premiums. I like to trade Macy's or DraftKings because they have smaller premiums. So those opportunities sometimes exist. But like I said, with option pricing, everything goes in a cycle. And knowing what not to do is probably more important than figuring out the right thing to do. When the market is moving, knowing when it's time to stay out is really, really important.
And that's a huge point because that's where a lot of people struggle and where they lose a lot of money when the market stops trending and it starts consolidating, and whatever was working for them before is no longer working.
John, it's not only consolidating. If anybody's got a chart, look at the gaps. Remember, options only trade during the New York session. So if something happens overnight, or at an hour before the open is when CPI comes out, non-farm comes out. You're at the mercy of all that. Look at the gaps in the chart of the S&P. It can be a horrible day, close right at the low, and the next day it just gaps up higher and rips your face off. There isn't a chance. There's been so many gaps, and they've gone in both directions. So you can go to bed at night thinking you're golden, and wake up in the morning and the opening print, you've had your face ripped off. So it's not only the sideways, it's sideways with violent gaps against you. It's the overnight is absolutely killed. It's absolutely killed. And if you're exposed to it, it's gonna get you.
Well, that's right, and it's good, folks, if you have somebody like Joe on your side walking you through this day by day. So I'm going to take a look at some of the academic guidelines in Key Point, and Joe, you can chime in any point if I don't tell it the way you want it here. You're trading straight puts and calls, outright purchases. You trades at about an average of 3 to 4 times per month, again, depending on market conditions. Minimum account size you recommend there is $10,000. Your strategy, basically, you're looking for pullbacks in an already established trend. And then you've got some confirmations to go along with that. Based on a $10,000 account size, you're allocating about $750 per option position. Is that correct?
Sure. That's good. Yep. But just be aware that it's going to be active, inactive, active, inactive. It was more consistently active 2 years ago. But again, I don't want to keep saying this, but man, this market changes the drivers. You know, it's not the old days where we all looked at money supply and, oh no, now we're going to all look at CPI. It's the actual drivers of the market, what's going on in the 0 day to expiry options, because the tail is now wagging the dog. And it's changed so much. So, yeah, and there are times when I just don't want to participate in options just because of the chop and the gaps, like I said, and that was one of those times. So, but it'll switch. It'll go back to where options are a great deal again. And the
Markets
premiums aren't that great. Right? It'll happen.
Yep. So some numbers on the key point trader. Again, this is going back from January of 2017 through November of 2022. That's again a $10,000 account size, allocating approximately $750 per trade. And during that period, that $10,000 non-compounded turns into $109,146 of net profit. That's a return on capital over 1,000%, averaging about 186% per year. And for those that like to look at that monthly average, you know, what can I expect if you're looking to generate income and so on? It's about $1,500 per month on average. Winning 68% of the trades. The average winner, nearly $600, with the average loss just $279. All right, that's where your winners are basically twice the size of the losses, which is great, especially with a high win rate like that. All right, let's get into everything that comes with the Joe services. You get obviously the trade alerts that come to your email or your cell phone. You get the daily market position recaps, so you always know where you stand, you know, what new trades have been open that day, what's been closed, what you're still holding. You get direct access to Joe for any educated questions regarding the markets or his methodology. The daily video commentary regarding the markets, the outlook, the specific trades that he's looking at. The educational material that comes with the strategy. So if you want to learn the strategy, right, you have access to the educational material. We do offer access to third-party registered brokers. That's an option, you know, if you don't have the time to do this yourself and you want the third-party broker to execute the trade. So there are brokers that have been trained to execute Joe's trades. They've been doing it for a long time. They can do that for you. Of course, you get access to us here at FFR Trading. You know, our goal is to build you a portfolio of strategies to give you a well-rounded, diversified portfolio, right? We never recommend you having just one strategy for that reason, for diversification. One of the bonuses when you subscribe is you get access to Joe's daily Skype group. Joe, can you tell us a little bit, because that Skype group, I've been in there and you know, the clients that you have there love it. Just tell us what goes on in that Skype group on a daily basis.
Okay, well, like I said, for anyone who wants to be on in the morning with me, I put up my trading screen so you can exactly see my own mouse move and me execute trades before the New York Open in the, you know, micro futures, or I use the mini futures, but most people would probably want to use the micros. So there's that. And then during the day, you know, if I see something that is of interest, you know, it can be a simple thing. Like the other day, people were saying, oh, this is way too overbought, I'm going to buy some puts. And so I just said, okay, look, guys, even if it is the top, the market almost never makes a V top. It'll make a top, come down, then go up and try again. So if you want to sell it, wait for the try again and see how that does. So there could be little things like that that can help people that are, you know, doing their own sort of stuff during the day, and guys share with each other too. I mean, guys will post stuff here that the other guys may find useful. If I'm doing a trade, an option trade that's outside of anything I'm posting because it's, you know, expires tomorrow or something like that, you know, I'll post it there, or I'll post, hey, I like buying the, you know, some guys are trading the triple leveraged ETFs, which are kind of a cool way. You don't have to worry about the time value like you do with options, and you still get some pretty good leverage. So I'll say, hey, listen, I like buying SPX here, and they can do with that information what they want. a lot of them, they will then trade triple leveraged ETFs with that information, since they're trading them anyway. So yeah, that's it's basically just it's a exchange of ideas. 3 years ago, we would have it was a little bit when things were not 99.9% governed by robots. There was more trades to do, but now you have to be more selective. So I am more selective, and yeah, so it's just it's a benefit to people who are at their computer during the day, want to see what's going on, want to input with me or anyone else if I'm around, and if you want to trade in the morning before the New York session opens, then you can watch me do it and copy it or use it as a tool or whatever you want.
Right, fantastic. And for those of you looking to take your options trading to the next level, have a serious look here at Joe's Target Zone Option Service. With either 1 or 2 years of service, you can experience a wealth of knowledge and insight from Joe Duffy and our team here at FFR Trading. So here's the deal. Until Monday, all right, for new subscribers that qualify, we do need to speak to you because we have to make sure this is a good fit for you. All right, this is not for everybody. All right, but Joe is willing to offer 50% off his standard licensing fees. All right, he's going to give you his Key Point option program for free if you sign up for his Target Zone service. He's already agreed to give you his scoop indicator for free if you subscribe to Target Zone. So you get an additional bonus plus the Skype group. All right, so with Target Zone, you're going to receive 4 to 6 texts or emails per month, depending on market conditions, with specific buy, sell alerts, so you can maximize your profits. You also get access to Joe's private Skype group. Right, he's going to teach you his top strategies. He offers his personal guidance. He's available to answer questions, provide real-time support in the markets. If that's not enough, Joe's going to provide also his daily updates on the market conditions, technical analysis, through his nightly video updates. So you can stay informed about any changes in the market in order to make, more informed decisions about your trades. All right, so don't miss out on this amazing offer, half off this amazing service. You get Joe's knowledge, his expertise in options trading at your disposal. Right, you'll be well on your way to success. You need to give us a call here at FFR Trading. We do need to see if this is a good fit for you first. Okay. I'll put up the numbers here. Just some questions too, while you think about what we're talking about here. Are you seeking a better financial future, but you're facing challenges in that current journey? Maybe you're a new trader, you're struggling to achieve profitability. Or maybe you're an experienced trader, you just haven't been able to, reach the same level of success as someone like Joe has. Imagine the impact that it would make to partner with a seasoned professional like Joe Duffy, who has a proven track record of helping others reach their financial goals faster. Are you facing a time crunch? You're unable to devote time to manage your investments. Having Joe's trade signal sent directly to a registered broker, that could take that burden off of your shoulders, but yet help you to reach that desired financial state. Think about the potential impact, of experiencing returns of over 50% or 100% on your investments. With Target Zone's option program, you could bring the change you've been searching for in your financial life. So as you ponder those questions, here's the numbers to call: 800-883-0524. You can call the 832-404-2420 number if you're outside the U.S. Support at ffrtrading.com is the phone number. Again, you're going to get Joe's Target Zone option program for 50% off its regular price. Plus, Joe is kicking in his Key Point options program that trades straight puts and calls. He's throwing that in for free. And then just on this webinar, he's agreed to also throw in his scoop indicator. As you heard him say, he's charged $10,000 for this indicator in the past.
And that's software add-on too, John. That's not a piece of paper that you figure it out. That's a software add-on. Okay.
All right. So think of the value that you're getting here. Would this help change your financial life? Give us a call. It's worth talking to one of our strategists just to see if this is a good fit for you. If it's not, we will tell you. All right. All right. So call that number. You have until Monday. I would call as soon as you can. Joe, anything you want to add before we let everybody go here?
No, I just think I know. I would say this, guys, like just because it's been sideways for a few weeks or 3 months, so is the market. And I know people get discouraged, and then when it goes up, then they go, oh, well, let me get in now. And it's just like a stock, it takes 2 steps up, then it pauses, then it takes 2 steps up, then it pauses, right? So the pauses are when you get in. That's how I built the scoop indicator. You don't chase it when it's going up. You get in when it's resting, right? And you're prepared for the next up. So yeah, the systems have been resting, but they're just preparing for the next leg.
Now, Joe, there's also a rumor that you're offering a free round of golf to anyone that's out there in Palm Springs.
Okay. Yeah. Well, it depends which day you get me. Well, I don't know if you'd like that or not. Yeah.
You'll have to give Joe a healthy handicap.
Yeah. Well, some days not too bad, but some days not too good.
All right, guys. So contact a strategist here at FFR Trading at 800-883-0524. Just see if this is a good fit for you. We have other strategies. If for some reason this is not a good fit for you, we can show you some other stuff. But think of all the value you're getting here. Like I said, I've been doing this for a while, and I haven't seen a deal like this come along. So take advantage of this. Guys, if you have more questions, you can send them to support@ffrtrading.com. We'll get your questions answered. We'll go through those. We will send a recording of the presentation here. But remember, this does expire. The offer does expire by Monday. So get that done and enjoy the replay if you want to rewatch that. But other than that, guys, I think we'll go ahead and wrap up here. Appreciate you coming out and take advantage of this offer, and we'll do it again very soon. I think we got webinars scheduled each month here this year. So, all right, guys, you have a great rest of your trading week. Joe, thanks for stopping in and sharing, your wisdom and knowledge in the markets here and offering this great deal to our subscribers here. So, guys, have a great rest of your trading week, and we'll see you back next month.
Thanks, John.